welcome to your real estate journey, expert tips for buyers and sellers. I'm Dolly Torres, your real estate expert, realtor, and loan officer. And today I have David. David is an account executive over NewFi, and we work together. And I'm so glad that he has agreed to come with me on this podcast so we can learn more about non-QM lending and how all that works. David, welcome. How are you?
Very good. How about yourself?
I'm doing well. So today, talk to me about the Asset Depletion Program that you guys have. How does it work? What is it? What does the documentations look like?
Okay. Well, with regards to asset depletion, it gives an option to borrowers who have the assets, who have money, but don't really have the ability to show income on a regular basis. So we may have self-employed borrowers, we may have some retirement borrowers. But it's typically for an asset depletion, it's borrowers who may or may not have an income stream, but they have plenty of assets that it's a little frustrating when they know they can cover their monthly obligation with the resources they have, but they can't show it with a pay stub or a bank statement or something of that nature.
So what would be the documentations that they would need to provide for this program?
It depends on what assets we use. So when it comes to asset depletion, there's two different things. The first step is, what is a qualified asset? So not all assets are eligible or qualified. So cryptocurrency, unfortunately, not something you can deplete. Business funds, not something you can deplete. But we, whether it be savings or checking, which you can get 100% value towards that as a qualifying asset. You can even do stocks, bonds up to 80%, or even retirement accounts, 401ks, IRAs, even if they're not of retirement age. So if they're under 59 and a half, we can still give them 70% value.
Of their 401k?
Of their 401k, correct. So we have that ability, and those are some of the eligible assets. Now, for them to be qualifying, there's kind of three different criteria for qualifying assets. It could be $1 million, which the vast majority don't necessarily have that liquid, or they may all accumulatively, but maybe not. It could be just 1.5 times the loan amount, which we do run into quite a bit, especially for like second homes and so forth, and somebody that is a smaller purchase, but they do have a retirement account, for example, of several $100,000. That works. Or we can do assets that are at minimum 400,000 but have enough to cover 60 months worth of their payments and their obligations. So you would basically take their PITI mortgage, plus if they have additional liabilities, the car payment and so forth, just add that together, multiply it by 60, and if it exceeds 400,000, if their assets cover that amount, they can do an asset depletion of any amount they want down to a floor of 400,000. So you kind of have that floor. Okay. But that's it. So that's how we qualify the asset. Once we have the asset, and then to qualify the monthly eligible payment is just those qualified assets divided by 60 months. And that would be the monthly payment that we use, or monthly income that we would use.
And what would be their minimum credit score and the down payment percentage?
Well, so the credit score is relative to the LTV. So it is tiered. Okay, so when we can go as high as 90% LTV or 10% down with a 720 FICO score. Okay, if they go down to 15% down or up to 85% LTV, then we can do that with a 700, or we can do 20% down at 680 or even 660.
Great. And what would be like the ideal person who would probably be looking into this? for example, I know there are some that there are other loan types like bank statement loans, and there's a bunch of non-QM products.
Right.
So this one, why would someone use this product versus a bank statement loan or a 1099 CPA letter, like we discussed in
Right.
our previous podcast?
Okay, there's a couple different things. One is that it's ease of use. I mean, to get 12 months bank statement, some people just don't want to expose, 12, all of their bank statements and their money that is coming in and out and so forth. Others don't. When it comes to bank statements, for example, we do have to see a certain level of consistencies, and there's times where overdrafts or NSFs could become an issue. When it comes to asset depletion, we're just looking at the most recent 60 days or 2 months of bank statements and using it for seasonality so that we show that they are seasoned funds, and we just can calculate it out that way. The people that are most attracted towards the bank statement, the asset depletion, are those that just don't want to get cumbersome with documentation. They want to provide the least amount of documentation as possible. And if they have the asset, that's the path of least resistance, is what they do. The good thing with NewFi is that we do allow blending of programs. So as you mentioned, with the 1099 or the bank statement, we can qualify somebody using bank statements or 1099, but we could also, if they're coming in short with their DTI and they have a 401k or an IRA or retirement account, several $100,000 in there that they aren't touching, but we want to use it for qualifying purposes, we could do that on top of the other program. So it will be additional income that can be used on top of that bank statement or even a full doc loan if we needed to.
Got it.
So it supplements.
Perfect. David, thank you so much. I really appreciate you coming to with us and explaining the programs. And you guys at home, if you have any questions, I'm a loan officer and I'm also a realtor. So feel free to reach out to me, and I can actually get you in contact with David if he needs to be, but normally it goes through a loan officer first. And if you want to know anything about any specific products, leave it in the comments and I will definitely try to help out and talk about the product. And David is an expert in the matter, so I'm pretty sure he will be happy to come with us and explain the product. David, thank you so much, and I'll see you guys next week. Bye-bye.
Bye-bye.